Hey guys, Kylie here, and in this video I'm going to run through how to get started with Forex, including understanding fees, pips, and spreads, and I'm going to run through some of the strategies that will make your life easier when you start trading. And if you're keen to learn more investment tips and tricks, don't forget to hit the like and subscribe button. And just remember, while we really hope that this video will help you get a better understanding of the subject, this is not personal financial advice. When in doubt, always seek expert help. The foreign exchange market is one of the largest markets in the world, with trading taking place between one currency and another in pairs. So as an example, you might trade the Australian dollar with the US dollar. While it was once largely the domain of hedge funds and companies, these days it's become really popular with individual investors too, mainly thanks to the rise of trading platforms and investment apps. Other reasons Forex is so popular is because the markets are open 24/7, 5 days a week, and it's one of the most liquid markets in the world. Plus, online brokers also tend to offer leverage, which means that even a small deposit can have you trading large amounts. Another big draw card is that if you use the right strategies, trading Forex can net you really big returns. But also keep in mind that trading Forex involves substantial risk of loss. But before you start earning those big bucks, it's worth pointing out that Forex trading isn't always straightforward. In fact, you'll need to master a few terms and strategies first. In Forex, the broker will list two prices when trading any currency pair. The bid price is the price at which you can sell the base currency. That's the currency listed first. And the ask price is the price at which you can buy it. Because you're buying or selling a currency in relation to another currency, there'll always be a difference in price. And this difference is what's known as the spread. So let's say you're trading the Australian dollar with the US dollar, for example. Here, the broker may offer a sell price of, say, 0.76594 and a buy price of 0.76604. To get the spread, you need to subtract the sell price from the buy price. In this example, you're left with a spread of 0.0001. How much the spread is for each currency pair will be determined by the market and by the broker, and its value is measured in something called pips. Pip actually stands for percentage in point or price in point, and it's simply a measurement of the smallest possible price change between a pair of currencies. What that means in Forex is that for most major currency pairs, a pip is equal to a price movement of 0.0001, with brokers quoting currency pairs out to 4 or 5 decimal places. The only exception to this is the Japanese yen, which is typically quoted to 2 decimal places. Okay, so returning to our Australian dollar, American dollar example here again. Here we said there was a spread of 0.0001, so the difference between them is therefore 1 pip. Knowing the value of a pip will tell you how much you've lost or how much you've gained when trading currency pairs. You should also pay attention to the fees you have to pay. Some Forex accounts will charge a flat fee on brokerage or commissions, while other brokers will charge 0 commissions. When it's the latter, brokers will usually incorporate their commission from their spread in the exchange, hence making their money by selling currency at a higher price than what they paid for it. Of course, there are also other factors that can affect the size of the spread, including the volatility and liquidity of the currency pair that you're trading. If you're starting out as a casual trader, you may want to look for the lowest spreads on a no brokerage account. For example, IC Markets, the sponsor of this video, offers some of the lowest brokerage fees on the market for standard or 0 brokerage accounts. And these spreads fall as low as 0.0 pips on its commissioned account. Commission being it charges a fee per trade. Okay, now let's look at some of the ways you can start trading. A popular form of trading Forex is price action trading. This is where you follow the price of a security, so in this case a currency, to find a good buy-in point. You then trade off the back of that with the help of price charts and technical analysis. A good place to start can be by drawing trend, support, and resistance lines to help you track lower and higher price ranges, which can help warn you of oversold conditions, like when it dips below 30, or if it increases above 70. If these tools are new to you, we've covered these and other basics of technical analysis in our beginners video, which we've shared in the description below. So when devising your strategies for trading in Forex, indicators can help you track current trends and give you an idea of certain conditions in the market. There are of course a lot of different ways to analyze candlestick charts. All of them involve drawing trend lines to try and forecast the direction a price is heading in. While we're not going to go into the details too heavily here are a few brief examples, starting with the triangle. The triangles are a continuation pattern that are formed by drawing trend lines on your chart that converge in the shape of You guessed it, a triangle. These can be plotted between the upper and lower trend lines, and generally give an indication of where a price trend may be headed, whether in an ascending, descending, or symmetrical value. A lot of traders watch for price breakouts from triangle patterns. When the price breaks from a narrowing triangular pattern, particularly at high volume, it can signal a potent new trend. Similar patterns come in the shape of pennants, rectangles, and wedges. Another form of technical analysis is called the Elliott wave theory, which was developed to predict price movements by analysing the psychology of traders. After all, so much of trading comes down to human behaviour. Created by Ralph Nelson Elliott in the 1930s, this theory refutes the idea that the market is inherently chaotic, instead proposing that it can be arranged in waves of patterns which can be spotted and followed. While complicated for beginners, the so-called fractal approach to investing can be beneficial to Forex trading when analysing the long-term currency trends of one currency against another. Anyway, let's finish off by looking at a couple of the most popular strategies for Forex trading: scalping and day trading, although they are very interchangeable. If you're a beginner to Forex trader or a casual investor, you might not start off by scalping or day trading, but it still pays to understand how they work. But you should know a little bit about both strategies anyway. With Forex scalping, the aim is to buy and sell currencies in very short order, only holding on to them for very short time frames and making a lot of trades during the day. Like all Forex trading, the goal is to make a profit on the currencies you buy and sell through the movements of exchange rates. If we roll right back to our example of the USD and the AUD example, if you were to buy US dollars at the US to Australian exchange rate of 1.3368, then sell them later at 1.3468, the profit would equal 0.0100 or 100 pips. The scalper would hope to make profits by making a series of similar trades. Likewise, day traders will also make a high volume of trades throughout the day, utilising many of the technical analysis tools we've already run through in this video to make short-term gains. Day trading can see you netting large profits quickly when done well, but unsurprisingly, it also comes with a lot of risk. Therefore, it may not be the best strategy to follow when just starting out. That was just a quick overview of Forex trading, and I hope it gives you a better understanding of some of the popular strategies that are used. And we'll have a few similar videos coming up, so you'll really be able to get a handle on trading. Thanks for watching, and if you like this video, don't forget to hit the like and subscribe button.